Hello, hello, party people. Welcome, welcome, welcome. Guys, we're just going to give everyone a minute to jump in. Just while we're waiting for people to join, if someone could please just let me know in the chat, just confirm that the slides and audio are coming through. Okay, that would be great. Perfect. Thank you, Lavina. Working, got a bunch of thumbs up. Great. What's happened here? Oh my. Perfect. All right. Uh, um, cool guys. Look, I'm pumped to get into it with you. I think it's a great time of year to be on the front foot when it comes to your money. Reality is that for a lot of people, tax time does get them thinking about their money. But a lot of people do it like reactively after the end of the financial year. Sorry, I just want to make sure my video looks like it's frozen to someone else. Is that coming through okay at your end, or is that a me thing? Paused. Can you guys hear me? I can see it frozen. You can hear me. Well, that's a good start. I've got my most intense concentration face on there. Let's have a look. Try again. Oh my goodness, the tech is failing me. I turned my video off. All right. Well, we're just going to roll it like this. You guys, exactly, back. Okay, great. Perfect. Thank you, team. Sorry about that. So look, guys, yeah, I think a lot of people do this stuff reactively after the financial year is finished. And the reality is that if you wait until after the financial year is finished, it can be too late to really change anything. So it's you want to be smart now to make sure that you're doing the right things to set yourself up so that you don't wish that you'd done stuff after the financial year is finished. And that's exactly what we're going to get into today, guys. As we're going through the content, I'm happy to get a little bit off track with any questions that people have. Feel free. I love seeing the chat in the chat itself. But if you've got a question and you want to make sure that your question gets answered, pop that into the Q&A box, and then I can just tick them off as we go through. Also, guys, if you're not already familiar with our content, there's a bunch of it out there. So we've got a heap of events that are coming up. You can check them out on the Eventbrite page where you registered for this event. Also, there's a heap of content on socials and the Pivot Wealth website as well. So get around that. My book is out. I just re-released my second book. So yeah, check that out as well. Also, for the lawyers, guys, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly suggest you seek out personalized advice. And just for the question, yes, we are recording the session. We will share it with you guys later. My jokes are funny live though, so stay tuned. But we are going to share it for a limited amount of time after today as well. Alrighty. So guys, look, for anyone that's seen some of our talks before, you may have heard me talk about the financial potential levers that everyone's got available to them. Basically, these financial potential levers, they're the things that you can do to improve the trajectory that you're on with your money. Basically, you spend less money now, you can save more money, you're going to get ahead faster. You spend less money in the future, you don't have to get as far along. You can increase your income, that allows you to save more without sacrificing. You can invest and work for longer. That means you're not spending your money for as long, longer to build. Pay less tax. And this is clearly the focus of today. But it's my favorite one of these levers because it's one of the only ones that allows you to save more money without sacrificing anything. And, in today, we got cost of living crisis, we got interest rates up, we got all of these things that people are sort of finding the threshold where it's like it's hard to sacrifice more money. But reality is that if you save on tax, that means that you're actually getting more money out of the money that you've got. And it's why it's probably is my favorite one of these levers to use to actually get ahead faster. But look, guys, I know that it's not easy, particularly when it comes to tax. Like, everyone's situation's unique, but there are three big sticking points that hold people back when it comes to being smarter with their tax. The rules are complex. Yeah, there's a lot of rules. They can be complicated, confusing. There are a lot of unknowns. So people want to be smart, but they're not sure if there's something that they might be missing that can mean that they're actually not being as smart as they think, and that can be a little bit paralyzing. And it's getting good help is hard to find around your tax. I'm going to talk a little bit more about what you should be looking for in this space. But, the days of an accountant really being your partner that is the solution to saving your tax, they're effectively over, because for accountants, they can only charge what is a relatively small amount of money, $100, few $100 to do a tax return, which might even seem expensive. That means that they're limited in terms of how much time they can spend with their customers without losing money. And so as a result, what happens for a lot of people, they get stuck in it, not stuck doing nothing, but they're stuck missing out on the opportunity to get more money out of the money that they've got. So if you want to nail it with your money, there are three areas that you need to get right. Today, we're really talking about tax, but I just wanted to plant the seed to say that it's not the only thing that you need to get right, that you want to be on top of your structure, make it easy to save, make it easy to manage your money, make it clear how much money you've got to work with when it comes to things like saving and investing and some of the tax strategies that we'll talk about. Then we've got strategy, which is getting the most money out of the money that you've already got, having the best pathway forward. And then the third one is the investments that you actually use, because saving tax is great, but all it really does is give you more money that you can then invest to get ahead faster. So if you're going to be investing, you want to make sure when you do invest that your investments are making you money. So that's really important, but sometimes it's easy to lose sight of. And so I just wanted to plant the seeds to say today I'm going to give you guys a bunch of ideas around tax, things that you can do, things to be smarter, but know that it's just part of the picture here, really. So, look, I want to start from the basics, and then we're going to get into some of the tax hacks and strategies. Now, in Australia, we work under a marginal tax rate system. What that means is that there are different tax brackets, and based on your level of income, that you're going to pay different rates of tax. I'll unpack those tax rates in a second. One thing, though, that is important to really understand is that you only get one tax rate. So when it comes time for doing your tax return or doing your submissions into the ATO, basically all of your income from all sources is added up together into one big pile, and that is your assessable income, to use a bit of jargon, but in the ATO's eyes, that's your taxable income. So that includes salary income, overtime, commission income, bonus income, interest income on bank accounts, dividend income from your investment portfolio, rental income from your investment property. Basically, all of the incomes all add up together to give you one number, which is your total taxable income, and that is taxed at marginal tax rates. Sometimes people mistakenly think that there are different tax rates or different tax treatment for interest income on a bank account compared to their salary, but it's actually not. It's all the same. It's all assessable income, and it's all taxed in the same way. It does also include, and I saw a question from Alistair about restricted stock unit or RSU income. So yes, that all adds in together. Alistair, I might actually come back to this question. It's not in the slides itself, but I'm happy to chat a little bit about stock income. For anyone that's not sure what that means, it's generally when you work for a company that's got an employer share plan, and they're giving you shares which become available to you over a period of time. That comes with a few tax consequences. Huge opportunity, but can be a little bit curly as well. So look, in Australia, these are the marginal tax rates. So basically on the first $18,200 of income that you earn, you don't pay any tax. Then above 18,000 up to 45,000, you're paying tax at 19 cents in the dollar. 45 to 120, it's 34.5%, including Medicare. 120 to 180, 39%, and then 180 plus is 47%. I've also put in the new tax brackets, which will kick in from 1 July, because the good news is every single taxpayer and every one of you guys online is getting a pay rise because tax rates are coming down from the 1st of July, meaning that they're going to be a little bit lower. So there's some tax savings there that are up for grabs. Now, one thing that confuses people is that even if you earn $1 million a year, your marginal tax rate, like you're obviously right up in the top marginal tax rate, but even for someone earning $1 million a year, you still pay 0% tax on the first 18,000 you earn. You still pay, and I'll just go back to the current tax rates, that you still pay 19% tax on the income earned between 18,000 and 45,000. You still pay 34.5% on the income earned between 45 and 120,000, and so on and so forth. So your effective tax rate is not necessarily your marginal tax rate, but basically say if you earn $200,000 a year, you know that every extra dollar of income that you earn, or if you get a 10 grand bonus or you get 10 grand of shares from your company, that's going to be taxed at your marginal rate, which is unfortunately the highest rate. And in this case, it's 47%. And so that's an important thing to keep in mind when it comes to your tax strategies and your investment strategies as well. And one thing that you should also be aware of is that tax rates are different for different entities. And basically an entity, and apologies for using a bit of jargon, but a tax entity is essentially anything with a tax file number attached to it. So pretty much if you're investing, you can choose to own the investments in your personal name. So you can open up an account with Perla or Self-Wealth or E-Trade or ComSec or whatever. You own the account, and then you own all of the income, the investment income that comes off that account is allocated to you and taxed at your marginal tax rate. But you don't have to be the one that owns your investments. You could choose to own investments inside your super fund. And if you do that, then your super fund pays tax on the investments. You could also choose to own your investments inside a company, inside an investment bond, or inside a trust. And when you own the investments in these other tax entities, then those tax entities are the ones that pay tax on that income. I get that can be a little bit confusing, but you should just know that there is can be a significant difference in the tax outcomes depending on where you own your investments. And the reality is that today, like, we're going to talk about the things that you can do to increase your tax deductions and therefore increase your tax return. But you should also know that there's a limit to how much you can actually do when it comes to your how much you can push down your tax bill. There's no limit to the tax savings that can come from investing your money. And so it's something that's really powerful. I'm going to get into this in a little bit more detail when we get a bit further into some of the more advanced tactics and strategies that we're getting to. And so, guys, I'm gonna shift gears in a sec and talk about what you can do in terms of cutting your tax bill. But before I do, I just want to give a shout out to our event partner for this event, which is Perla. Perla, you guys are probably familiar with them already, but if you're not, we don't get any kickbacks or anything like that for this partnership. But basically, there's a strong alignment in terms of their approach to investing and making money. And ours, that they're a platform for long-term investing. They don't have any kickbacks. They just do great work. And so they're bringing the event to you guys in conjunction with us today. Alrighty. So I just wanted to talk about how to cut your tax bill firstly, and the things that you can do to actually get that down. Now, the first thing is around your tax deductions and keeping good records. Reality is that most people miss out on or don't get as much back as they should at tax time simply because they don't know what they can claim. And so, they're the common deductions, and I'm going to get into some of the most overlooked deductions in a second, but knowing what you can claim and then making sure that you're claiming it is often going to be the difference between you getting hundreds, but potentially thousands of dollars extra back in your tax return. Keeping good records, though, is a critical part of this, because if you don't keep records of your tax deductible expenses throughout the year, when it comes to tax time, you're sort of like scrambling and going, where are the receipts? Can I find them? Did I claim that? How much was that? When did I spend? Where is it? And it gets too hard, and then you end up just moving on and missing out on expenses and deductions that are there. And so, first thing and most important thing is you've got to know what you can claim, and then make sure that you're keeping records so that you can easily claim it at the end of the financial year. Understanding what you can deduct and knowing what you can claim based on the sort of work that you do and your work setup as well, particularly for people that either work from home as part of their role or are doing things like site visits or doing travel as part of their role. Really knowing what you can claim. And the ATO have a bunch of really helpful content on their website. It's quite easy to understand and digest. They've got a whole bunch of different occupation types, some of the weird and wonderful things that you can claim for them, knowing if you can claim, sunscreen, uniform, sunglasses, all of these different things, and basically making sure that you're aware of what you can claim and that you're claiming it. Advice and education is another tax planning opportunity that a lot of people aren't fully aware of, that basically any self-education expenses or professional development expenses, with the aim of increasing your employment income, can be deductible. And so I think I was looking at some stats, and they're basically the average Aussie spends $1,900 a year on professional and self-development. And so deducting that means that you're getting, potentially almost $1,000 or more, depending on your tax rate, back for self-education. And so when to claim these, and this is something you should definitely confirm with your accountant, but typically, if you're doing something that can further your career, even if you're an accountant, but you're learning about public speaking skills or being effective in your role, there can be a reasonably direct implication to your income, and that can make it deductible. The other side of this coin is around getting advice. So tax planning advice and advice on generating investment income can help you to actually save tax and to get some tax deductions at the same time. And so, you're getting the support to actually save more money on tax, and that support is tax deductible. That's a great combination in my book. Another thing that you can do to pull down your tax position at tax time is that if you're investing, and particularly if you've got investments that are sitting at a loss position, that selling investments that are sitting at a loss can offset not your other income, but it can offset other capital gains. So if you've got some shares that have gone up, or you've incurred some capital gains throughout the year, and then you've got other shares that have gone down, they can basically balance each other out, meaning that you're not going to have to pay more tax as well. And so it's worth always, if you're investing, having a good look at your investment portfolio before the end of the financial year. And if you are, considering making changes and potentially exiting some of those underperforming investments, doing it before 30 June can give you a big tax leg up for the new financial year as well. Private health insurance is another one. So basically, if you earn above a certain level for couples and singles, is about $90,000 for individuals, about $180,000 for couples, that if you don't have private health insurance for hospital cover, you actually get charged with what's called a Medicare levy surcharge tax, which is like an extra tax at 1 or 1.5% of your income, potentially meaning that you're paying hundreds or thousands of dollars in extra tax every year. Often that can be more expensive. The tax can cost you more than the cost of the actual health insurance. So to say it a different way, making sure that you've got private hospital cover means that you're avoiding paying this extra tax, and the tax is more than the cost of health insurance, meaning you're effectively getting health insurance for free and saving tax at the same time. So that's a little bit complicated, that rule, but you should definitely be across it, particularly if you're starting to, hit your straps from an income perspective as well. Going to get into tax strategies, but I can see a few questions that have come through. So I'm just going to come into these. Jackson says, can I deduct online courses? Look, you should confirm with your accountant, but online courses that are helping you in your career or grow your career, they're generally the sorts of things under the ATO's rules that would be deductible. And so anything like even content subscriptions for maybe not for your Netflix, depending on what your job is. Maybe if you're a video producer, then maybe there's an argument there. But more so, like if you're working in finance and you've got a finance magazine subscription, then that is stuff that I would think as a non-accountant, I would think that would be deductible. So all of those sorts of things that people, content subscriptions are way up with this stuff. And so, being aware of them, I think is really important and can be quite valuable. Can you offset capital gains from a property sale against a loss from shares? Yes, is the answer to that. And like I say, all of these questions confirm with your accountant, but if you've got, it's basically all capital gains. So it doesn't matter if the capital gains are on property, shares, crypto. If you've got gains and then you've got capital losses, that they will balance each other out and you pay tax on the net gain. If you've just got losses and it's the net position is a loss, then that carries forward to future financial years and then can offset with your gains in future financial years as well. Sheridan says, can capital losses only offset capital gains or can they offset dividend income as well? Unfortunately, Sheridan, that it is gains for gain. So if you've got capital losses from investments that they won't offset investment income, they also unfortunately won't offset employment income tax as well. Unfortunately, sorry to be the bearer of bad news there. Another one, it says Perla versus Raise versus Spaceship. Is there any difference between them? What would you recommend? Well, look, I can't, make any recommendation without getting into a lot of hot water under ASIC and our compliance people. But I would say that they're relatively similar in terms of the product. Excuse me. There are slight differences in terms of the investments that you can access and a little bit in terms of the structuring, but largely there's a lot of similarities between those products. They can be different from a fee perspective. And I know Spaceship, I believe that they have recently reduced their fees a little bit, but I think they're probably, they certainly in the past, they were like the most expensive investment platform in this particular space. And so you want to just look closely at the fees when you're considering these products. But then I think it partly comes down to personal preference. Look, one of the most important things that I think if you're looking for an investment account is the ability for you to invest automatically over a period of time. And my understanding is that all three of them have a really good ability to do that as well. So it partly comes down to personal preference. If the fees are basically the same and the investments are basically the same, it's like, which one do you like the best? Which one are you most comfortable with? The good thing of these accounts is that they're free. They're free for you to set up and to kick off. So you could even try a couple and see which one you like the most as well. Paul says, how far can I prepay an expense and claim the whole amount in this financial year? Can I prepay many quarters of council rates of the investment property in advance and claim them in this financial year? That's a good question. I'm not 100% sure about that. I believe, though, that typically my understanding of the rule, and please do confirm this with an accountant, but my understanding of the rules around this stuff is that if you prepay expenses before the end of the financial year, because they've fallen into this current financial year, that you should be able to get the expense deductible in this current financial year as well. There may be a limit. Would you really want to prepay 100 years of your council rates, though, just to get some extra tax deductions? I'm not too sure. That is quite a curly one. I might actually put that into our newsletter Q&A and come back to you with it, do a bit more investigations. But I think definitely some, but I'm not sure if there is a limit to that, Paul. one more, and I'm just going to jump into this tax strategies piece, but please, guys, keep those questions coming. I can see stuff in the chat as well, guys. Just so I'll try to cover some of those, but just so I can make sure that they don't get missed, there's a Q&A box in the menu bar. Pop the questions into the Q&A, because then I can just tick them off as I get to them and make sure that nothing gets missed as well. Can you please share the mechanics of an investment bond and associated tax benefits, how to purchase it, minimum commitment, 10-year benefit period, and broader redemption basis? Good question. Just trying to think if this is coming up on a slide. Is it coming up on a slide? I'm not sure. Look, I'll just get into it, and maybe it does come up on a slide, but basically an investment bond is like an investment account. It's sort of like, some of those investment accounts were mentioned, Pearl Array, Spaceship, etc. Except the difference is that it's got some similarities to a superannuation fund in that there are some specific rules. And if you follow those rules, then you get some tax benefits, like with super. If you keep your money there for long term, you get certain tax concessions. Investment bonds are the same. So typically, an investment bond, you can invest in a range of shares, managed funds, ETFs, similar to a normal investment account. A lot of people, that confuses a lot of people that think that an investment bond means that you're buying bonds, which is a completely different type of investment. An investment bond is just an investment account, which is subject to the investment bond tax rules. With an investment bond, there are two main tax benefits at least. The first is that if you keep your money invested for 10 years or more, you don't pay any capital gains tax on the gains made on those investments. And that can be a pretty significant tax saving. The second tax benefit is that while the money is growing inside the bond, that the income that's generated from those investments is taxed at a maximum rate of 30%. And often it's a bit less than that. So if your investment income is taxed at 30% instead of your marginal tax rate, you're generally saving a pretty, depending on how much money you've got invested, there's some pretty significant tax savings up for grabs. And so, look, these products can get a little bit complicated. You can get quite into the detail. We were just looking at for a client of ours that's about to kick off one of these bonds. And some of the complexities were honestly sort of blowing my mind a little bit. So you can make it really detailed, but that is effectively the big picture. So I hope that helps. Guys, I'm loving seeing all those questions. Please do keep them coming through. I'm just going to power through this section, and then I'll jump into some questions as well. So tax strategies. Firstly, I think it's worthwhile to, when you're doing your tax planning, you want to plan in July to actually do your tax return and know what your tax refund position is. If you're getting a refund, that potentially lodging your return so that you can get your tax refund back ASAP. But April is the other time to be planning for tax, because that gives you, it's not too late to do this in June, but doing it in April means that you've got time to change more stuff. And if you want to prepay expenses or get some tax deductible advice, or actually, do some education to bring down your taxable income, that you've got a comfortable amount of time to actually do that. You understand what your position is, and you can get strategic. Franking credits is another tax strategy, and franking credits is basically when you invest into Australian shares, particularly in bigger companies in Australia, that they will typically pay you dividends, which is like the profit. So you're investing into a company, you own a tiny little slice of the company, and as the company runs its business and generates profits, part of the profits get paid out to the shareholders in the form of dividends. Now, in Australia, with Australian shares, when you receive those dividends, if the tax has already been paid by the company on the profits, then you receive a tax credit for the tax that was paid. That's called a franking credit. And franking credits, different to the capital gains and capital losses stuff that we were talking about before, franking credits actually are tax credits that can offset the amount of tax that you pay on your other income. So if you have a big taxable income with franking credits that have got these franking credits attached to them, can actually mean you get a massive tax refund on your employment income as well. And so it's a pretty powerful strategy. It also means that because the income you receive is more after tax, that you need less money to get more after-tax income. And to say it like a different way, that if you've got $1 million invested, it's going to give you about $50,000 a year in income. Say, just to use round numbers, that if that $50,000 is franked dividend income versus non-franked dividend income, there's quite a difference in the after-tax income that you actually receive. And so, yeah, it's a pretty powerful way to save tax. Negative gearing is another tax strategy where basically the most common form of negative gearing in Australia is when you borrow to buy property. Basically, gearing just means borrowing to invest. So anytime you're borrowing money to invest into anything, whether it's property, shares, crypto, anything else, you are gearing. The negative and positive part, negative gearing, positive gearing, that refers to the cash flow of the investment. So you add up all of the income, say with a property, which is a simple example, you've got your rental income, which is basically the only income that you get on the property, and then you've got your expenses, so your mortgage interest costs, your council rates, your insurances, all of those sorts of things. And if the overall income is negative, then that's referred to as negative gearing. Now, with negative gearing, you are able to claim a tax deduction for the amount of money that you're out of pocket, or the net cost of your investment. And so that means that if you own an investment property, it might cost you 10 grand a year. You might have to tip in 10 grand a year after the rental income that you receive. But you claim it as a tax deduction, you get, somewhere between a third and half of it back. So it only actually costs you, $5,000, $6,000 or $7,000 to fund that cost. And then you get the upside on the investment as well. And so negative gearing is not a quick fix strategy, because buying a property is a big deal. You got to be smart. You got to manage your risk. You got to do all of these things. But, some pretty significant tax savings on offer there. Investment bonds, just spoke about that one. I thought that was on a slide. Debt recycling is another strategy, and debt recycling is one of my favorite strategies because it sort of seems almost like illegal, but debt recycling is effectively a strategy that works for home owners, where you own the home that you live in with a mortgage on it. And basically how the strategy works is that when you have a mortgage on your own home, the debt is not tax deductible. Whereas when you have a mortgage against an investment property, or you borrow money to invest into shares, the debt is tax deductible. The interest cost on that debt is tax deductible. And so how debt recycling works is that it converts your non-tax deductible debt into tax deductible debt over time. And so a practical example is that if you've got, say you had a $500,000 mortgage, and you had $500,000 sitting in a bank account, you could pay down, $499,999 on your non-tax deductible home mortgage, and then you take you draw the $499,000 out of tax deductible debt and use that to invest typically into shares. And when you do that, because the purpose of that borrowing is to invest into shares, that it means that the interest costs are generally tax deductible. And so that has effectively turns your non-tax deductible debt into tax deductible debt, but it does it without actually increasing your overall debt levels. And so it means that, you had $500,000 of debt at the start, you have $500,000 of debt at the end. So you've got no more debt, but your debt is now better debt because you're getting tax deductions for it. And so, practically that's a pretty extreme example, because not a lot of people are kicking around with $500,000 sitting in their bank account, but you can do it $1,000 at a time, $10,000 at a time, and you basically convert that debt over time. So it's a great strategy. And it does seem like almost like too good to be true. There are some complexities, and I don't want to oversimplify it. It is a complex strategy. You definitely should get advice with this stuff, but it can be a really good one to help you pay down your non-tax deductible debt, build a nice share portfolio, increase your tax deductions, cut your tax bill, all at the same time. Super contributions. Look, this is not a very exciting one, but it is a very effective one. Everyone can contribute up to $27,500 into their super fund each year and claim a tax deduction, including the money that's contributed by your employer under the super guarantee contributions. And so for most people, that with the compulsory contributions, there's still a significant amount of room for them to put in more of their own money into their super and claim a tax deduction for that money. That happens whether you can put money in from your bank account, or you can do it through your employer via salary sacrifice. So long as it's marked as a tax deductible contribution, you're going to get a tax deduction for that money. The downside is that once you get money inside your super fund, it's trapped there until you're old. So you need to be, you don't want to go put your property deposit into super, but it's an immediate tax deduction. So if you do it through salary sacrifice with your employer, you could tell them to put $10,000 a year into your super fund through salary sacrifice. Your pay won't go down by $10,000 because they take it out before tax. So it doesn't even cost you 10 grand to get 10 grand into your super fund. All right, so I'll jump into some of these questions. I'm going to come back to Alistair's one. Firstly, just talking about restricted stock unit income, so RSUs, and this works. It commonly happens for tech workers. Tech companies are quite big on their RSUs or restricted stock units, their employer share plans. Basically, what catches a lot of people out with these plans is that they might receive $10,000 or $50,000 worth of shares in their company. Just say that they work for Apple, for example. Apple gives them 10 grand worth of shares, and generally they vest over a period of time, which means that every 6 months or every 12 months, some more of the shares become available, and you could sell them if you wanted to. At that point in time, when the shares become available to you to sell if you want to, there's a tax that basically it's like your employer gave you a cash bonus worth whatever the shares are worth, but didn't withhold any tax. So if that's 10 grand, then there's like, depending on what your income is, that there's probably $4,000 or $5,000 of tax that will be payable on that 10 grand of income. If it's 100 grand, it could be 40 or $50,000 of tax. And so what generally happens with people when they get these restricted stock unit plans is that it starts small and it slowly builds up. But then all of a sudden, if they don't have a strategy in place, you turn around and you're just getting hammered with these massive tax bills. And you've got these shares there, which is obviously this is a first world problem. But it is a problem because you get these big tax bills, you can be forced to sell. And you want to be smart because there is a big opportunity with the RSU plans, but you do need to be on the front foot. And there is also, while there is a lot of opportunity there is also a pretty significant risk that comes with RSU plans. We've seen over the last decade and a bit, we've seen a number of people where they've received shares through their employer share plan. They get a big tax bill, but then the value of the shares goes down. And it goes down, and then they have to sell because they've got no other money to pay the tax bill. And they basically get not even enough to cover the tax bill, and you sort of end up behind. You can even end up with an ATO debt. So that to me seems like wrong in terms of the rules, but those are the rules, unfortunately. And so if you've got an RSU plan, there is a level of complexity there that it's definitely worth getting some good advice from someone that actually understands them properly. Question to reinforce this point. Someone has just said that they've got 250K worth of RSUs and the share price is down 35%. Whether to sell, or the question is sell or hold. Obviously, that's the question that I can't answer, but it's a question that you could address through getting some formal advice. I would say though that fortunate in that if the shares are 35% down and you sell them, that you definitely would have enough money to pay for the tax bill. If it was 70% down, then basically the shares are worth less than what the tax that you owe on the shares is, which is a total disaster scenario. And I've had clients, there was one client in particular that had a whole bunch of shares that vested, got a really big, and it was a significant amount of shares, got a really, really big tax bill. And then the share price just plummeted, and they basically could have sold them. There was an earning call. The share price went down by like 30%. They started freaking out and thinking, do I sell? Oh no, it should probably come back. And then the share price just kept going down and down and down. And they had to take a significant haircut in the end. It was an absolute disaster. And to me, the rules just seem completely wrong in that circumstance. I don't believe that was the intention of the rules, but it is the rules that are there. And so, yeah, you want to be really careful with that one. Sorry, I can't, answer more directly, but I think it's a question that you should definitely answer. Dylan says, what's the difference between salary sacrifice and a voluntary contribution? Would it be more advantageous for one over the other? So basically, from a tax deductibility perspective, a voluntary contribution, so i.e. you just pay money out of your own bank account into your super fund, compared to you put it in through your employer, the tax deductibility is exactly the same. The impact on your overall tax position is the same. But the difference is that if you did this every month, say from July, on the 1st of July, you put $1,000 into your super fund. You'll get a tax deduction, but you won't get that tax deduction until you submit your tax return after the 30th of June, the following financial year. So you're waiting for a long time to get the benefit of putting that contribution in. Whereas when you tell your employer to put $1,000 into your super fund through salary sacrifice, then when you get your pay packet, your pay would have actually gone down by like $500 or $600 or something like that, meaning that it hasn't cost you $1,000 to get $1,000 back in your to get $1,000 into your super fund, and it means that you've got that extra few $100s that you can invest or save or do something with between now and when the tax year actually finishes. Josh says, I've got an investment loss from 2021. Can I include it in this year's tax return, or is it too late? So that's a good question, Josh. Typically, when a loss is incurred, when you have a capital loss, that you want to report it on your tax return, and then it becomes a carry forward capital loss, and it basically just sits there until a year where you have a capital gain that you can then use to offset the capital loss that's there. If you forgot about it, you may need to do a tax adjustment, but you generally report capital loss in the year that they made. And if there's no other gain to balance it against, it will just carry forward to future years. Another question says, do tax deductibles include graduate certificates related to your current field of work? I think under the ATO's rules, that's exactly what it is, that if you're paying for study that relates to your work, that is generally tax deductible. So I would think yes. Haley says, where can we find more details of the capital losses, capital gains tax rules? The ATO website is probably a good place to start. You could also look at some of our content. I have put out a fair bit on tax on our socials, Instagram at Pivot Ben, or TikTok at Ben Talks Money. David says, more details about the motor vehicle deduction. So basically, yeah, motor vehicle deductions is a big area for people to claim. There's a lot of opportunity there because motor vehicles are expensive to run, and so basically you can claim a tax deduction of up to $4,000. It was $3,900. It's now $4,250 every year. Without actually keeping a logbook, or if you keep a logbook, you can even claim more if the expenses are higher. So basically, there are two methods that you can use to make deductions. Oh, got some balloons here. Tax deductions are exciting, guys. Two methods that you can use for tax deductions on your motor vehicle. You can use the fixed rate method, which allows you to claim a tax deduction of 85 cents per kilometer traveled for work purposes, up to a maximum of 5,000 kilometers a year. And you can do that without keeping a logbook. The travel does need to be for work purposes though. And while you don't need to keep a logbook, you need to be able to substantiate your claim if the ATO asks. So you basically need to have records of the trips, when they happen, where you went, what the distance of those trips were. But there's a pretty big deduction there. Under the logbook method, if you track all of your travel in a private vehicle, then you can you can calculate the percentage that you use your vehicle for work purposes versus private purposes, and you can deduct proportionally. And so say, for example, you're 50% private, 50% work purposes, you can then deduct 50% of the operating, 50% of all expenses relating to your car as a tax deduction. That means interest costs on the debt if you borrowed to buy your car, petrol costs, insurances, rates, tolls, all of those things. Generally, you can claim the work percentage. And so, yeah, it does need to be for work purposes, though, the travel. And so what that means is that normally just traveling to and from the office, is not work. Obviously, it's work related travel, but it's not ATO work related travel as well. But if you're traveling between work locations from one site to another, visiting suppliers or customers, then that would generally be considered a work related trip. Guys, I'm loving seeing all these questions coming through. How are tax strategy services priced? Is there any industry standard? I might come back to that one because I'm going to talk a bit about tax and who helps with this stuff. Can we claim membership fees like PMP Prince 2 against education benefit? I don't know what that is. Sorry, PMP Prince 2. Maybe. Sorry, I'm a bit ignorant on that one, but feel free to clarify. We want to set up an investment for our 5-year-old. How does that affect our tax? So if you're investing for your kids, really good question. Basically, if you invest in your name and you just have an intention to give your investments to the kids in the future, you'll need to pay tax on the income and gain from the investments over the time that you have them. And so this sometimes catches people out. You can, excuse me, you can also invest in your children's name, but there are different tax rates. And for minors, that the tax rates are actually a bit higher. I would suggest if you want to dive deep on this, check out on the Pivot Wealth blog. I actually don't do tons of blogs these days, but there's a blog on there that I did in collaboration with Perla, who are our event partners for today, all on this exact thing. And it dives, because it's quite technical, so it dives deep in there. All right, guys, I can see a ton of questions, but I'm just going to power through a bit more of the content, and then I'm going to circle back. I'm going to circle back to this as well. All right. So we're going to talk about tax myths and mistakes. One of the common ones that I see is that people are trying to stay in a lower tax bracket. They think that if they're going to get a pay rise or a pay bump that pushes them into the next tax bracket up, they think that overall that's going to be bad from a tax perspective. But if you're sitting just underneath the next marginal tax bracket and you get a pay rise, the higher rate of tax only applies on income earned above the threshold for the next tax bracket. And so to say it a different way, there is no point on the tax brackets whereby having a higher income, you end up with less money after tax. Can be a little bit confusing. HEX is a slightly different issue, but from a pure income and income tax perspective, then that's what it is. Offset versus redraw is another big tax mistake that I see, because for some strange reason, the ATO view an offset account versus a redraw account slightly differently. And what I see a lot of people do, particularly for people that buy their first home, they think they're doing the right thing, trying to pay down their mortgage as quickly as possible. And so they bring that debt right down. But then you fast forward a few years and the people want to upgrade and get a slightly bigger property. And when they do that, they're generally, they've got this low debt on this first property. They've got no money to go and buy the second property, maybe a bit of savings, but they still need to borrow a lot of money to buy the second property. And what happens is that they want to keep the first property for to be an investment property. It was a good property. That's why they bought it in the first place. They've got a bit of a sentimental attachment to it. And so but the debt is really low. And so that creates a tax problem, because there's no, they rent out the property, there's no expenses, there's no mortgage cost to offset the rental income. You start paying tax on that, and then you've got this your own home which has this high mortgage which is not tax deductible. Really ineffective. If you go down a different path and you use an offset account, if you save up money into an offset account and sort of build up 100,000, 500,000, $1 million in an offset, if you take that money out and use it to pay for your next property, then the debt goes back up on the first property and means the deductions are higher against that property, because you can turn it into an investment. It's going to have higher interest costs. It's going to be less of a tax problem. Don't know if I explained that too well, but essentially it is very different from a tax perspective. And so you want to be careful if you've got a property, if you are actually paying down the mortgage, thinking about what's coming up, what's around the corner. Not tax planning before investing can be a problem as well. I mentioned that there is a big opportunity to save tax when it comes to how you're investing money. It can also be difficult and expensive to restructure your investments after you've set them up, after they've started growing. I will just say, guys, that next month I'm actually doing an event which is on our Eventbrite page, all about how to invest tax smart in the new financial year. And that session, the main focus of that session is going to be on how to save tax when you're investing, as opposed to just how to cut your tax bill before the end of the financial year for this current financial year. So if you're interested in that stuff, and if you're investing, I would strongly suggest that you register for that event, come along, because there's a bunch of stuff to be aware of and be smart with there. Apologies, guys. I'm not sure if you noticed, but I'm pretty much on the verge of having a major coughing fit. And so I'm trying my best not to be croaky. I hope that's not coming through in the audio, but I'll just sip away this water and keep my fingers crossed and hope for the best. Advice with an agenda: you want to be really careful if you are getting people to help with your tax, and particularly accountants. I find that they can sometimes, I know that there are a lot of fantastic accountants out there, very great advice, very ethical, all of those things. But I have seen clients where they get suggested by accountants to set up trusts and companies and do all these different things, which have really questionable benefits. Sorry, team. Have questionable benefits. And so I think you just want to be careful, particularly if you've got accountants or people, anyone really, that's telling you to do a bunch of stuff for tax purposes. Just make sure that the benefit that you're getting is more than the cost that you're paying for that stuff as well. All right, tax questions. I don't even know that I need this section because I can see so many questions in the chat, so I might actually focus on those ones instead. I will actually answer these couple of questions though, because I did have this one in the chat before, in the question Q&A before as well. In terms of who helps with tax, so obviously your tax accountant can do your tax return, that will do your tax return lodgement, or you do it yourself, but generally it's done with an accountant. If you're doing, though, your tax strategy, so should you do concessional super contributions, negative gearing, use an investment bond, that actual strategic, forward-looking, big picture tax planning stuff, that is a financial advisor's job, not an accountant's job. And so the two should work, pretty much hand in glove, or a lot of cases for individuals that are not business owners, that the advisor is really directing the strategy with obviously you, but then the accountant is doing the work and making sure that things are getting optimized with the strategies that you are doing. I think sometimes where accountants, you go, I want to save tax, they go, I'll put a bunch of money in your super, but then they're not thinking about the fact that you want to actually buy your first property or an investment property in 3 months' time. And so it's actually, while it may save you tax to get it into your get money in your super, it's not going to be a great strategy for you. How to find a good accountant? It is difficult. I will just say that, because most accountants don't want to work with individuals because they can't really charge enough to add tons of value. You want to look for a tech-led solution. I think can be quite helpful, where you can actually build your knowledge, or ask around friends that have people as well. You do want to also, though, with an accountant, you want to know at least a little bit before you go to them, so that you can then go, well, what about this? What about this? Can I do this other thing? So you'll get a lot of benefit out of doing your research before you jump in. Cool, guys. I'll just share this model and then I'm going to jump into the Q&A, because I can see that there's tons of questions in there. So I'll leave you with this one, guys. It talks about getting from where you are to future state with your money. And, when people think about this stuff, they think it's like a straight line, but because of the compounding impact of time and money, it's not. It's actually a curve. So it doesn't matter where you want to get to. If you're not 100% on track to be there right now today, you need to do some stuff. Be smarter with your tax, start investing, ditch that debt, whatever the things are. And when you do that, once you do those things and what we call jump the line, then you just need to take the next step and the next step and the next step, which is easier because you're already on the path. But what happens is the more time goes on, the longer you leave it, the jumping the line bit becomes more and more painful, and putting yourself in the best position can become impossible. And so the longer you leave it, the more that goes on, the more you have to do to end up in the same position. And so, look, guys, I hope you've got some great ideas, some good things for you to think about. But you're only going to save tax by doing stuff, by actually cranking some deductions, by being smarter, by keeping better records, by implementing a tax strategy. And so I'll leave you with one thing off the back of today, make a time to actually take action and make it happen. Guys, if we can help through our content or events, you know where we live. We've got a ton of stuff coming up. I mentioned before at that event coming up for July as well, so you can check that out. Or there's heaps of tax content on our socials as well. Alrighty, so I'm going to jump into these questions. So I did have a couple of requests actually for the most overlooked deductions, so I will skip back to that. I did mention a lot of these ones already though. Education expenses is a big one that I spoke about. Investment advice, career coaching, development, building your income, home office expenses, travel related costs, and fees around your investments or investment advice as well. So those are the common ones. They can be the chunkier ones as well, particularly travel costs and motor vehicles and those sorts of things too. Alrighty. Kavinda says, is there benefit of doing share investing compared to investing through a TFN? Look, if you're doing it through a company, then there are different tax rates that apply. If you're doing it as a sole trader through an ABN, then my understanding is that it's the same tax rates that apply, because with a sole trader, it's like you just receive all of the income yourself. That's my understanding. Hope that helps. Lily says, if I take my money out of the house offset to invest, is that tax deductible? The answer is typically no. If you were to pay the money into your mortgage and then redraw it from your mortgage and then invest it, then the purpose of that borrowing would be to invest. And so that's generally deductible under the ATO's rules. If you put money in an offset and then take it out, the debt never actually reduces. So taking money out of an offset, you're not borrowing money, you're just moving money out of an offset. And that's the difference between offset and investing. Hope that helps, Lily. A little bit confusing. Jess says, who will be the best person to discuss debt recycling with? Financial advisor is the person that you would want to talk to. You could talk to an accountant. We sometimes talk to our clients' accountants about this stuff as well, and just finessing the finer details. But generally, an accountant would not be able to advise on that. Also, a mortgage broker might be part of the picture there as well. With Hazel says, with franking credits, is there any document we need to send to the ATO, or is it automatic? It is automatic. So it's all reported in the ATO dividend reporting system is all really solid these days. You will get your dividend statements, and it will have a franking credit, section on there. And you want to make sure that that is consistent with what's in your tax return. But yeah, it all goes through the ATO portal these days. Curious if you have any tips for lower income earners. I'm a student, being my first year past the tax-free threshold. Well, look, I would say your deductions are worth less, so you probably shouldn't stress yourself out about it too much. Obviously, if your income's below 18,200, then you're not paying any tax, and so tax deductions are not going to get you any money back. So again, you wouldn't for tax purposes do things like super contributions and those sorts of things. But as it builds up, and particularly I'd say that if you're a lower income earner and you're looking to set yourself up for the future, then you want to be really smart and tax efficient when you invest. And for that one, I would say jump onto that event we've got coming up next month. We're going to dive into that in a fair bit of detail. Josh says, just to confirm, you only pay tax on shares once you sell them. So there are two parts, two taxable incomes. I suppose you can, to use a label that you could get from shares. One is the income or the dividends that you receive. So if you receive a dividend from your share portfolio, then that is taxable income. And even if you hold the shares forever, you will pay tax on that income. But if you sell, or when you sell shares, then there is a capital gain or loss. And that will be taxed at that point that you actually sell them. So yeah, two slightly different, but similar. I'm just going to I can see the questions, and guys, please, feel free to hit us up if you're really stuck on any questions, or come along to that next event, and I'll make sure that I got a longer block for Q&A, given that there's so much stuff in here as well. We also do Q&A through our weekly newsletter. So if you've got burning questions that you want answered, subscribe to that, and you can hit us up, and we'll do our best to get those answered as well. Christine says, if I put money in my super before the end of this tax year or in next week, can I claim for this financial year? Yes, that's how it works. So long as you put it in as a tax deductible contribution, then you will get to claim it in this current financial year. Look, guys, it's an exciting time. I appreciate all the questions and engagement as well. It's so great to see. Another shout out to our event partners in Perla for collabing on this event. Check out the ones that we've got coming up. Check out the content. And guys, good luck end of tax year. Hope you got some great ideas there. Look forward to seeing those refunds come in, no doubt. And I'll catch you on the next one, team. Bye for now.